ETFs, mutual funds, stocks. You have heard these words 1,000 times. Maybe you have even nodded along pretending you understood. But here is the truth. Most people have absolutely no idea what the actual difference is between them or which one is going to build their wealth fastest. Today I am breaking all three down so simply that by the end of this video you will know exactly which one is right for you and exactly how to start. No jargon. No fluff. Let us go. Welcome to Money Blueprint, real wealth strategies for real people. Subscribe because I post new content every single day. Let me start with the simplest possible explanation of all three, and then I am going to tell you which one actually builds the most wealth for regular people. Because the answer might genuinely surprise you. First, what is a stock? When you buy a stock, you are buying a tiny piece of ownership in one single company. If you buy Apple stock, you literally own a small fraction of Apple. When Apple does well, your stock goes up. When Apple struggles, your stock goes down. Simple enough. Here's the problem with individual stocks for regular investors. Picking the right company consistently is extraordinarily difficult. Professional fund managers with teams of analysts, research tools, and decades of experience fail to beat the market consistently over time. The idea that a regular person sitting at home can consistently pick winning stocks better than professionals is, statistically, a fantasy. Some people get lucky. Most people lose money trying. Second, what is a mutual fund? Instead of buying one company, you pool your money with thousands of other investors, and a professional fund manager uses that combined money to buy hundreds of different stocks. Sounds great, right? More diversification. Professional management. Less risk. Here is the problem. That professional manager charges fees. Sometimes significant fees. 1 to 2% annually sounds small. It is not. On a $100,000 portfolio, a 1.5% annual fee costs you $1,500 every single year. Over 30 years, accounting for the compound growth you missed, that fee can cost you over $100,000 in lost wealth. And here is the brutal irony. Most actively managed mutual funds consistently underperform the market average after fees. You pay more and get less. Third, what is an ETF? An ETF, exchange traded fund, is the game changer that most people have never been properly introduced to. Like a mutual fund, an ETF holds hundreds or thousands of different stocks, giving you instant diversification. But unlike a mutual fund, an ETF is not actively managed by an expensive fund manager trying to beat the market. Instead, most ETFs simply track an index. The most famous example is an S&P 500 ETF, which automatically holds the 500 largest companies in America in proportion to their size. When those companies grow collectively, which historically they have done at an average of 10% per year for nearly 100 years, your ETF grows with them. And the fees? A typical S&P 500 ETF charges around 0.03% annually. Compare that to the 1 to 2% of an actively managed mutual fund. On that same $100,000 portfolio, the ETF costs you $30 per year versus $1,500 for the mutual fund. That difference compounded over 30 years is genuinely life-changing. So which one actually makes you rich? For the vast majority of regular investors, the answer, backed by decades of financial research including the life work of legendary investors like Warren Buffett and John Bogle, is low-cost index ETFs. Not because they are exciting. Not because they promise dramatic returns. But because they are mathematically the most efficient way for a regular person to capture the long-term growth of the entire market without paying excessive fees to managers who statistically cannot beat that market anyway. Warren Buffett, widely considered the greatest investor in history, has repeatedly said that when he dies the instructions for his wife's inheritance are to put 90% in a low-cost S&P 500 index fund. Not individual stocks. Not mutual funds. Index funds. Here's what the data actually shows. Over any 20-year period in history, the S&P 500 has never lost money. Not through recessions. Not through wars. Not through pandemics. Not through financial crises. Every 20-year period in market history has been profitable for patient, consistent investors. The average annual return of the S&P 500 over the last 100 years is approximately 10%. At 10% annual returns, $100 invested monthly starting at age 25 becomes approximately $600,000 by retirement. The same $100 per month starting at age 35 becomes approximately $200,000. Same investment. Same discipline. $400,000 difference simply from starting 10 years earlier. This is why the most important investing decision you will ever make is not which stock to pick. It is when to start. And the answer to that question is always the same. Now, here is exactly how to start investing in ETFs today. Step 1. Open a brokerage account. Robinhood, Fidelity, and Vanguard all offer free accounts with no minimum investment requirements. You can literally start with $1. Step 2. Search for a low-cost S&P 500 ETF. The most popular options are VU, Vanguard S&P 500 ETF, SPY, SPDR S&P 500 ETF, and IVV, iShares Core S&P 500 ETF. All three track the same index with extremely low fees. Step 3. Set up automatic recurring investments. Even $25 per week invested automatically removes the temptation to time the market and ensures you are consistently building wealth regardless of what the market is doing on any given day. Step 4. Do not touch it. Seriously. The biggest mistake investors make is selling during market downturns. Every market dip in history has been followed by a recovery. Every single one. The investors who build real wealth are the ones who stay invested through the turbulence and let compound interest do its work over decades. Here is the bottom line. Stocks are exciting but risky for individuals. Mutual funds are diversified but expensive. ETFs are diversified, cheap, and historically the most effective wealth building tool available to regular people. You do not need to be a financial expert to build real wealth through investing. You need consistency, time, and the wisdom to keep it simple. Low-cost index ETFs give you all of that in one straightforward package. Subscribe to Money Blueprint because every single day I share the exact investing strategies that regular people are using right now to build real lasting wealth. And tell me in the comments, are you currently investing, and if so, what are you investing in? I really enjoy every single comment, and I genuinely want to know. Your answer might be exactly what someone else needed to hear today. Everything you need to start investing today is linked in the description below. Your wealth building journey starts right now.